Well, let's address the macro headlines that we're getting at this point of time. As we pointed out, WPI has turned negative. A negative figure of 0.92 is what the April reading is telling us, and that is coming after the CPI figure, which was already sub 5% and has had come at around 4.7%. Let's try and decode what this means and what are the other macro factors at play. We have with us Mr. Jayesh Mehta. He's the MD and India Country Treasurer at Bank of America. Jayesh, hi. Thank you so much for making time and speaking with us. First up, after looking at the WPI data and CPI data, should we say that the peak of inflation and the worst of inflation is behind us?
Absolutely, absolutely. So even if you look at when RBI kind of paused, they were also thinking on that lines, but well, the actual numbers definitely gives very encouraging sign. So definitely, I think unlike other countries, we don't have to now worry about inflation for the time being.
So that's the take coming in as far as inflation is concerned. But what does it do to your RBI rate expectations? They had hit the pause already. Do you expect a rate cut soon?
That's a big question. So I think even when they, if you really look at their language, people were expecting that it's a temporary pause and there could be a hike depending on the data and stuff like that. But that was very natural to say, especially when you fought so long for getting inflation into control. You just don't let it away so simply, right? So I think that's one part of it. Um Now, with the current inflation data, whichever there are very few people who are also thinking well in the camp that could be a rate hike because of the language spoken in the last policy, they also given up the rate hike situation. As far as rate cut is concerned, right now, of course, the most easiest path is to follow what US is doing, and therefore, we may also, that's what the swap market pricing our rate cut. In first quarter of calendar year 24, right? But of course, I don't think we really look at the rate cut at this juncture, but you never know. I think first quarter, which looked like completely away from the rate cut, I would give now maybe 50% probability of a rate cut in first quarter of 24 calendar. So last quarter of this financial year, we might see a rate cut, hopefully, if the things settle down much better.
Okay, so a 50% probability that the start of the next year or the first quarter of the calendar year 24, we're likely to see a rate cut happening as well. But Jayesh, what did you sense? The IIP data is pointing to a bit of sluggishness. The IIP data for the month of March was not too strong. What does it do with respect to the growth expectations that we should factor in for FY24?
So we will still continue, and I'm a little bit more optimistic than the economists. So I will still go with the RBI growth projection, but with the IIP number coming lower, and then second half growth projection for the market broadly is looking lower. That's the reason for my 50% probability for rate cut, which I was not really expecting. So for US cutting the rate, we don't need to really cut the rate, but then, the focus might actually move to growth and the balance growth and inflation focus can kind of bring a rate cut in first quarter next year. Of course, there are some people in the market looking at December quarter also rate cut, which I don't think so, but you never know what can happen.
Yeah,
Too
let's see
early to
what.
say.
Too early to say. Let's see what happens. But Jayesh, wanted your sense regarding the 10-year as well. After 13 months, we have seen that it's close below the mark of 7%. What's your expectation? What could be the sustainable number for the 10-year yield in the next, let's say, 3 to 6 months?
So 10-year definitely looks sustainable below 7%. Maybe, June, July, typically, you have the supply thing coming in at the peak. Typically in April, May, you have a lot of coupon payment. This year was a little bit of anomaly also because, you had taxation on mutual fund and insurance change. So a lot of money came into insurance and mutual fund by 31st March. So that demand was also very high. And that's why, at the beginning of the year, you are thinking. So if you really look at if your next rate expectation is going to be a cut, whether it is December quarter or Jan-March quarter, or even if it is after that, then 40 basis point over repo rate is very well justified 10-year, or maybe even 35 over repo rate is justified 10-year. But it looks a little surprising, in general, that with so much of supply still pending, at least the first half of the calendar financial year supply is still pending till 30th September. You are seeing this kind of rally, and that's mainly, I would say, because interest flows are always there in May, but I think it is more also to do with the insurance and mutual fund flow which came before 31st March, and that was very huge. So that is actually helping it to upfront the thing. But yeah, you might see a little bit hovering around this, maybe 10, 20 basis point plus minus. But maybe once July, August passes through, 40 over repo rate is a pretty justifiable rate, 35, 40 over repo rate.
Okay, so the 10-year is likely to have around the 7% mark, maybe plus minus 10, 20 basis points. Jayesh, on that note, we'll let you go. Appreciate you joining us on the show today. In the meantime, let's listen